Will big U.S. banks face tougher capital hits next year, or is it steady as she goes? Here's what the Fed just decided, and what it means for your portfolio. The Federal Reserve finalized the hypothetical scenarios for its 2026 bank stress tests and chose to keep current stress test-related capital rules in place for now. That gives banks and investors near-term clarity, while the Fed reviews public feedback on possible changes. In plain English, the guardrails used in 2025 will still apply as banks plan dividends, buybacks, and balance sheet growth this year. Stress tests are the Fed's annual checkup on whether large, complex banks can keep lending through a severe downturn. Regulators run each firm through a standardized what-if recession: sharp economic contraction, higher unemployment, credit stress, and big drops in risky asset prices. Banks with big trading or counterparty exposures also face a sudden market shock, capturing fast moves in rates and spreads. The results feed into each bank's stress capital buffer, an extra layer on top of minimum requirements designed to absorb losses in bad times. By locking in the 2026 scenarios now, the Fed gives banks the inputs they need to run internal models and draft capital plans that match supervisory expectations. At the same time, by not changing the stress test-related capital framework yet, the Fed avoids abrupt shifts while it processes comment letters. That signals an incremental approach: gather feedback, refine methodology if needed, and only then decide on updates. For investors, the message is continuity. Capital thresholds stay where they were in the prior cycle, so payout policies are less likely to swing unexpectedly in the near term. Expect banks to proceed with planned buybacks and dividends within familiar limits, while keeping an eye on earnings, loan losses, and trading revenue that influence stress outcomes. Firms more exposed to corporate credit or market volatility may still see bigger modeled swings, but the rules of the game aren't changing midstream. What should you watch next? Management commentary on capital plans, CET1 cushions versus required buffers, and any guidance on balance sheet growth. Also note how rate paths and credit quality trends feed into loss projections under the finalized scenarios. Bottom line, the Fed delivered stability now and flexibility later. That reduces uncertainty today while leaving room to adjust once feedback is in. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.